Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at AST SpaceMobile.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We are really dissecting one of the most exciting, and I have to say, high-stakes infrastructure plays in the market today.
High stakes is definitely the right word for it.
It really is. I mean, this company kind of embodies that high-stakes physics gamble you see in the space tech sector. And that whole gamble is based on their proprietary direct-to-device technology, D2D.
Okay, let's unpack that right away because we talk about a company's moat all the time, right? But here, it's not just a business strategy. It's like rooted in physics.
It is. D2D connectivity from space has been the holy grail for, well, decades.
Right.
But the key differentiator for AST SpaceMobile, their whole value proposition, is that they're delivering 4G and 5G broadband service
To regular phones.
directly to the billions of unmodified smartphones that are already out there. The one in your pocket.
That's the game changer.
It's everything. I mean, if you just step back and look at the satellite internet landscape, the biggest point of friction always is the ground terminal.
The dish on your roof, the special phone.
Exactly. That hardware costs time, it costs money. AST SpaceMobile just eliminates it. They completely bypass the need for billions of dollars of hardware deployment on the ground.
Which gives them this huge advantage in speed to market.
A truly enormous advantage.
Yeah.
But it shifts the engineering challenge, right? It all moves from the ground up to the satellite itself.
Okay, so what does it take physically to do that? To grab a tiny little 4G signal from a standard phone,
Yeah.
but from, thousands of miles away in space.
It takes unprecedented scale. That's the core insight.
So these aren't your typical small sats.
Oh, not at all. These satellites, the BlueBirds, they use these massive phased arrays. The arrays are designed to unfurl in orbit to a spectacular 2,400 square feet.
Wait, 2,400 square feet?
Yep. For context, that's roughly the size of a tennis court, and it's 3 times larger than their last test models, which were already huge.
A tennis court in space just to pick up my phone's signal.
You need that colossal aperture to grab such a weak signal. It's just fundamental physics.
So the size is the receiver. But you still need a brain to manage all that traffic, right? It can't just be a big mirror.
Absolutely not. The size gets the signal, but the brains manage the incredible complexity. And that brings us to their proprietary chip, the ASIC.
The AC5000.
The AST 5000. It's their IP-protected, application-specific integrated circuit. Think of it as a super specialized brain that lets the satellite manage 2,000 distinct cellular cells at the same time.
And what kind of speeds are we talking about?
Up to 120 millipedes, all running through 10 gigahertz of processing power. So it's that pairing, the massive physical scale with their own proprietary silicon, that forms a technical moat that is just incredibly difficult for anyone else to replicate.
And then they amplify that technical edge with the ecosystem they've built. Because the tech is one thing, but you need the distribution.
You do, and this is where the network effect, which people often forget about in space infrastructure, becomes so vital.
The MNO partnerships?
Over 50 of them. Mobile operator partners globally. The source material highlights AT&T in the U.S. market, which is a huge deal.
And why is that so critical?
Because these partnerships create 2 things. First, immediate scalable distribution, and second, really high switching costs for any competitor.
So they aren't out there fighting for new customers.
No, they're just integrating with the existing billing and subscription infrastructure of the world's biggest telcos. They walk right into a massive captive audience.
Which lets them target that, what was it, a $200 billion market of underserved mobile users?
An estimated $200 billion total addressable market. It's a genius model as long as the satellites actually work at scale.
Right. And when you contrast this approach with, say, Starlink,
It's totally different. Starlink is focused on residential customers, enterprise customers, all using their terminals. Kuiper is more cloud-centric B2B.
but AST SpaceMobile is laser-focused on the 5.3 billion people who already have a regular phone.
Exactly. Their pitch is simple. Use the MNO's customer base to monetize the satellites the second they're switched on.
So that's the bull case in a nutshell. An incredible technological advantage and a massive market partnership.
It is.
But the critique, the bear case, it always comes down to the money. This kind of build-out requires mountains of capital.
It does. And this is where we have to get real about the downside of any, revolutionary infrastructure play. We're talking about a company that is pre-revenue in its commercial phase.
The Q3 2025 results were disappointing to some.
They were, but they weren't unexpected. The entire strategy is to intentionally burn capital now. Heavy R&D, heavy deployment. That's the nature of a multi-billion-dollar CapEx project.
And that CapEx pressure shows up right on the balance sheet. That's the big concern for skeptics, right?
Yeah.
The debt.
The elevated debt, yeah. Specifically, that $850 million convertible senior notes offering due in 2036. This is really the financial core of the bear case. It's dilution.
Let's break that down because it's not just standard debt.
No, it's convertible debt. And this is where it gets sophisticated.
Yeah.
It means that if the stock price hits a certain trigger point, a sign of success, those creditors can convert that debt into millions of new shares.
So while it provides the funding, they desperately need to deploy the constellation.
The cost of that success is future dilution. It's like a dilution tax if they succeed wildly.
So the company's basically saying, we need this cash to execute, and if we do, the stock will rise so much that the dilution won't even matter. Like, that's a high-wire act.
It's the classic growth stock dilemma. Do you dilute now to fund the infrastructure, or do you starve the business of the resources it needs to get to critical mass?
Management seems aware of the pressure, though.
They do. They made some strategic moves, like repurchasing $50 million of their own notes. That move alone reduced their forward interest obligation by $13.5 million.
Okay, so they're trying to manage it.
Right. And while cash flow is still negative because of this intense CapEx phase, the overall cash position is reportedly solid. It shows they're prioritizing growth over immediate profit.
And this all brings us to the valuation, which tells a very aggressive story. The price-to-book ratio is currently sitting at 17.36.
That is an astonishing premium.
Put that in context for us.
Okay, so the PB ratio tells you how much investors will pay for every dollar of the company's assets today. The industry average for satellite and telecom infrastructure is around 1.23.
So they're trading at 17 times their asset value. What does a premium like that signal to the market?
It signals one thing very clearly. The assets today are almost irrelevant to the stock price. Investors aren't valuing this company on current profits or even near-term revenue.
They're betting on the future.
They are betting heavily monumentally, even on the flawless execution of that infrastructure plan by 2028 and capturing that $200 billion market. It's a futuristic valuation today.
Completely disconnected from the present financial reality. So the whole thing hinges on flawless execution. Let's shift there. What are the catalysts? Where does the de-risking happen? What are the milestones the market needs to see to justify this premium?
The first major step is proving they can manufacture these massive satellites at scale. We're seeing a critical shift right now toward operational efficiencies for the BlueBird Block 2 satellites. This is where the rubber meets the road.
And the Block 2 models are so important because it's not just a small improvement, is it?
No, it's exponential. The Block 2 models are crucial because they offer 10 times the capacity of the prior model.
What's 10 times?
10 times. This isn't a small gain. This is the difference between a proof of concept and a commercially viable global network. Scaling up manufacturing while maintaining that 10x performance is the immediate test.
So what's the forward guidance? If you're an investor looking for a hard target they have to hit, what's the number and the deadline?
The guidance is very clear. The critical execution goal is to deploy between 45 and 60 satellites by the end of 2026.
Okay, end of 2026.
Hitting that proves they can manufacture and launch at the necessary pace. If they miss that 2026 target, the market will punish the stock severely.
But if they hit it, what's the payoff? What are the projections that would justify that high valuation?
If they execute and they activate those MNO partnerships, company projections are targeting $500 million in revenue and 10 million subscribers by 2028.
That's the goalpost.
It is. And what's really compelling is that many analysts think those numbers could see upward revisions. They argue that once the MNOs start funneling in their existing customers, subscriber growth could accelerate faster than anyone is modeling right now.
And we have seen some recent positive news that suggests they're on track, right?
Absolutely. The market got a shot of adrenaline from the successful launch of BlueBird 6 on December 23, 2025, from India.
And that wasn't just another test launch.
No, this was key. This specific satellite enables D2D connectivity in underserved markets right away. It proves operational readiness and signals that, execution is moving forward on schedule. It mitigates some of that delay risk.
Okay, but that success was followed by the volatility we talked about. So let's turn to the technicals, because the stock's behavior has been fascinating.
It has been erratic, but directionally strong. Volatility is high, no question. We saw that sharp 7.3% drop right after the $850 million notes announcement. That's the market digesting the dilution risk in real time.
But the other side of that coin is the after-hours surges we see after good news, like production updates.
Exactly. That suggests the underlying technical strength is building higher lows. If good news consistently outweighs financing fears, it points toward a potential breakout.
And what are the momentum indicators telling us?
We're seeing several signs that technicians would call bullish. There's potential for a golden cross to form.
A golden cross, for anyone who doesn't know.
In simple terms, it's when the shorter-term moving average crosses above the long-term 200-day moving average. It's not a guarantee, but it's historically a strong indicator that a long-term bullish trend is starting.
And are other indicators confirming that?
For the most part, yes. We've seen things like oversold bounces on the RSI, which suggests the stock snaps back strongly after sell-offs. We've also seen hidden bullish divergence on the mass CD.
Which means?
It suggests the momentum behind the upward moves is actually stronger than the recent chart might imply. These signals tell me that institutional investors are likely accumulating shares on these dips, betting on that future execution.
And that optimism isn't just on the outside. Insider confidence is always a crucial signal.
It is, and the source has confirmed a material insider buy. Director Keith R. Larson bought 675 shares for just over $49,000 on December 10th.
Not a huge amount, but symbolic.
It's very symbolic. Making that purchase, despite the volatility and debt fears, is a strong sign that those closest to the action believe the company is undervalued.
So, looking ahead, the next 3 months, what should investors be watching? Q4 earnings are coming up in early February 2026.
Yes, but the key here is managing expectations. This won't be a traditional earnings beat story. The focus will be less on earnings per share, which will be negative, and more on forward-looking guidance. The market doesn't care about free cash flow right now. It cares about satellites in orbit.
So we're looking for updates on BlueBird 7 and beyond.
Updates on production for BlueBird 7 Plus, and any potential briefings on the activation schedule for those MNO partnerships. The milestones are physical and operational, not financial.
This whole analysis really boils down to one massive bet on technology and scale. So let's wrap this up. What is the final investment thesis? The elevator pitch that justifies all this risk?
The pitch is built on exclusivity. You have proprietary D2D 5G technology, which is now functionally unlocked by that BlueBird 6 launch. It's backed by the 10x capacity of the new Block 2 models.
Targeting a huge market.
A massive $200 billion market, and the infrastructure is essentially pre-sold through those 50-plus MNO deals, and you have insider confidence providing a floor.
And the debt, the $850 million, is the necessary evil. It's the capital they need to fund that critical 2026 scaling to hit those 2028 targets.
The dilution is the price of admission for this kind of exponential opportunity. But, and we have to say this again, the ultimate risk is execution.
It's all about execution.
This stock is fundamentally a bet on flawless execution. The top risks are delays in deploying those 45 to 60 satellites and the high capex costs that erode cash and could force more dilution if they fall behind schedule.
And if they miss that 2026 target,
that 17x valuation premium evaporates instantly.
Understood. So given all that, the time horizon here is not short-term.
Absolutely not. This is not a trade. The analysis strongly suggests a multi-year hold, targeting that 2028 commercialization timeframe. That's when the business model should be proven, and that multi-bagger potential could be realized. You're investing in future infrastructure, not current operations. You know, what's fascinating is that the high volatility is essentially the price you pay for access to this kind of opportunity. Closing that global D2D connectivity gap requires patience and a high tolerance for the financial gyrations that just come with funding a revolutionary project in space.
A powerful summary. If you want to keep tracking these critical market moves, make sure you subscribe to Smart Wealth with Joshua. We'll be here to track their progress right up to 2028 and beyond.